Before we get started, a quick disclaimer is that this content is sponsored by NEOS Investments, which is for educational and informational purposes only and not financial advice. Investors, welcome another special guest, a familiar face, Mr. Troy Cates, the co-founder and managing partner of NEOS Investments, where in this video, we're going to be talking about some high-income alternative ETFs, specifically their high-income gold product of IAUI, which does pay monthly income to investors for those who want to have exposure to gold with income as well. Now, in this video, once again, we're going to provide a full and complete breakdown of IAUI, the case for gold with income for dividend-focused investors, and the added benefit of diversification that an ETF like IAUI could provide to other NEOS products like SPYI as well as QQQI. So first question to you, Troy, is how are you feeling about IAUI gold right now and just lately about even SPYI and QQQI because investors love those products as well?
It was great to see you, Marcus. Thanks for having me on. Yeah, listen, we were really excited to get our gold product out. So IAUI is our gold high income ETF. We launched it this past summer in early June. And since then, it's been able to not only gather a good amount of assets during that time frame, but also have some really nice performance because everyone's been seeing what gold's been doing. Gold's one of those asset classes that for years people hold it and maybe goes sideways, but then when it rallies like it is now, it really moves. And for a long time, the investors that we've talked to have always some of them always have an allocation to gold, but they've never been able to really earn any income off the gold. And now with IAUI, you could have your allocation to gold and participate with the upside of gold and earn some income off that on a monthly basis.
First question for you, Troy, is what inspired the creation of IAUI? Because gold, of course, does not pay a dividend, but IAUI does pay monthly income to investors. And what gap does it fill in the current cover call ETF market with gold? Because I'm seeing other issuers launch other gold income products. And so what makes specifically IAUI different from other competitors that are launching income products from gold?
It's a good question. I think for us, we really look at ourselves as a solutions provider. So we started bringing out ETFs here at NEOS in August of 22, so over 3 years ago. And we started thinking about your asset allocation. And we started with SPYI, which was our equity high income at the time, looking at the S&P 500. We had BNDI, which is looking at your core aggregate bond for a fixed income allocation. And then we have CSHI, which is kind of, an ultra low, short duration product, looking at more of like a cash alternative for that 1 to 3 month T-bill. And from there, we wanted to keep slicing up the asset allocation pie. And we obviously brought out more equity high incomes like QQQI, IWMI, recently launched our international NIHI. And when we think about the alts, we have our Bitcoin, we have our real estate, but now we were hearing investors really asking for something in the space for gold. And how could we earn some income off gold? And you really, like you said, gold doesn't pay a dividend, but if you could harness the volatility around the options market of gold and take some of that and distribute it out, you have this nice product that can participate with the moves of gold, but also provide a monthly income stream from that volatility. So for us, it's really just adding another solution, another product to help you as you're looking at your asset allocation. We have 13 ETFs currently here at NEOS, and we're looking at bringing out more. We have another 6 in registration. So we're excited to get those out and continue to offer more products to people that are looking for income and looking to possibly lower the volatility of their portfolios while still investing in those different asset classes, whether it's equities, fixed income, alternatives.
Now, walk me through how IAUI pays that monthly income to investors with getting exposure to gold.
Sure. So we do this in a number of ways. So what we're doing is we're long gold in a sense of being long some of the ETPs to get that underlying exposure. But inside an ETF, you can only own up to 25%. So you'll see if you were to pull up our holdings, we have just under a 25% position in AAAU. And From there, how do you get that other 75%? So we do that via an options trade, a synthetic long. We're trading GLD options. And this is a synthetic long where it's built where we're buying a long call, selling a short put with the same expiration and the same strike, which gives you a delta one position to the underlying holding, which is GLD, which is tracking gold. So that's how we get our long position to try to track what gold is doing. And then to bring in the income, we're using those GLD options and we're selling calls on a monthly basis. We sell those calls out of the money. We do this through a rules-based systematic process where at the end of the month when we're rolling, we're looking out about 7 weeks to the third Friday of the following month. Our model is looking at the volatility around gold, the rate of change of volatility, and then picking the strikes that are out of the money, and then also saying how much of the notional of the underlying we should cover. And that's important, that part of it, because while we have this kind of target distribution range for the product, we want to make sure that we participate with gold. And obviously, we've seen what gold's done this year, and it's had a big rally. And when it has these bigger months, we want to be able to participate as much as possible. But when you think about being in a covered call product, there is a point where you can cap yourself out with those short calls. So by overlaying not on 100% of the notional, by overlaying on only part of the portfolio, you leave part of the portfolio uncapped, and that portion can continue to participate with the move of the underlying, which is gold in this case. So when we're thinking about it, we want to have exposure to gold. We want to earn some income off the volatility around the options market of gold, pay that out in a monthly distribution, and hopefully do that in the most tax efficient manner. So when people get that distribution and then at the end of the year, they see their 1099s, they hopefully have a good, net after tax distribution versus the gross distribution.
Could investors expect for IAUI to be more of a income product first and then like some sort of growth product, or should I say like capital appreciation? Or is it like the opposite of maybe some capital appreciation first and then income? Or maybe like a blend of both, like in kind of both ways?
Yeah, the idea is to kind of have both if you can. So we want to participate with as much of the upside of gold in this case, but also provide that monthly income that people are looking for off of their gold position. So yes, you're not going to capture all the upside, especially in a year like this where the market for gold is moving so quickly and it's rallying so much. But if we could participate with a good portion of that upside and still provide that monthly income, you get to the end of the year and you have this gold product in IAUI that has a lower volatility than if you just owned, one of the gold ETFs or underlying gold itself, and you get to get that income on a monthly basis. So for us, we're trying to give you a mix of both worlds. We're not trying to cap you out early. We're not trying to sell at the money calls on 100% of the notional. We're really trying to give the products room to move to the upside, but at the same time provide that income.
Walk me through why AAAU for the the gold exposure, and then of course GLD with the options chain. I'm pretty sure you chose GLD because of the liquidity. I'm sure.
Yeah, so we chose, to answer that one, we chose GLD for that liquidity. It's one of the more active options markets around any of these gold ETPs. So for us, it was important to make sure we had that liquidity and that there was enough different strikes. And while we're trading flex options, which gives us the ability to change strikes that are not listed or look at different ways, whether it's, we try to have these cash settled so you're not risking being called away. So it's little things like that. But yes, that's why we chose GLD. As far as AAAU, there's a number. We could have just been in GLD, but AAAU had a lower expense ratio. We thought it'd be better for the fund over time to not have something with such a high expense ratio.
What is the target yield range that investors can expect from IAUI?
So the goal is 10 to 12% on an annualized basis. And right now it's yielding right around 12%. So right in that range. And hopefully over time it could stay in that range. And the nice part about the way our model works is, on a monthly basis, when we're rolling these options, again, we're selling out of the money, but we're also covering only a portion of the notional. So right now we're about, as an example, 70% covered in the portfolio. So that's 30% of the portfolio that's not covered. But if volatility in gold comes down, the model can always write on more, 75, 80% to hit that kind of target range and make sure we're, trying to aim for that 10 to 12% on an annualized basis.
A lot of investors like sustainable yields. The current yield that IUI has is, as of September 30th of 2025, the yield is 12.63%. Now, how like sustainable are these yields in different like gold price environments?
No, it's a great question. And I think you could kind of see across all of our products, we have these ranges. SPYI, for example, is 10 to 12%. QQQI is a little higher. It's 13 to 15% because of the volatility there and so forth. So we have these ranges. And when we built these products and we decided what the ranges would be, we wanted to make sure that over time, the total return could support the distribution. And of course, there's going to be years where the market's down and all of the distribution is being sourced from the option portfolio and not by the total return of the underlying. So there's always those years. But over time, we wanted to, hopefully have the total return support the underlying distribution. So when we build these ranges, like for IAUI, this 10 to 12%, that's what we thought was a good range, a conservative range, not trying to over distribute or put out a big number. We just wanted to have what we think the portfolio could support over time. And so far, as you said, 12.63% as of the end of September. That's what, it's right in line with what we're trying to do.
Now, how might IAUI fit into a NEOS only ETF portfolio? Because so many investors might have a little bit of SPYI, a little bit of triple QI, maybe some BTCI, and then we hear diversification that gold has for investors. So how might IAUI fit into a portfolio of your product lineup where it could add diversification and like the benefits of a gold income fund?
We talk to advisors a lot about this, and a lot of them have set allocations what they put clients into gold. It could be 2%, it could be 5%. And for us, when you think about how the lineup for us here at NEOS has kind of been built around having these equity high incomes, we have equity hedge products, now the alts, the fixed income, and the treasury products, it really gives different options, pun intended, to pick what they want their asset allocation to be. And every investor is different. So when you think about, somebody investing, are they young and want to take more equity risk or want to take more cryptocurrency risk and like our Bitcoin product? Or are they older and they want to pull back on some of that risk and they want the equity exposure but don't want as much risk? And maybe they look at QQQH or SPYH, but still want to have a small portion in gold, or maybe they want to have a tiny portion in Bitcoin just to see what happens with it. So for us, we really leave it up to the investor to try to figure out what works best for them, because every portfolio, as you know, is different. Every investor is different and what their needs are different. So it really comes down to what kind of income are you looking for? What kind of risk are you willing to take in the market? And then you can kind of pick and choose what makes the most sense for you.
Walk me through flex options, because to my knowledge, that's what is being utilized with IAUI.
Yes. So flex options give you the ability or the flexibility to change some of the parameters of an option trade. So when you think about when you're picking a short call, for example, you're going to pick the strike price, you're going to pick the expiration, and most ETF or ETP options are American settled, meaning they can be called away at some point. They're not European settled, which are cash settled. So when you use a flex option, the nice part about not only being able to change some of those parameters, whether you want to change the strike, pick a different expiration than is listed out there, or even change the settlement, is that they're still cleared through the OCC, the Option Clearing Corporation. So by doing these flex options, you're not introducing any counterparty risk because you're still clearing as you would any other option that's not an over-the-counter option or a swap or an equity-linked note or something like that, where you might have some counterparty risk. So for us, we really enjoy having the ability to use flex options where we can, especially where there's no index options. A lot of our products, you'll notice, use the index options. And when it comes to gold, there is no gold index option currently. So if that changes down the road, that might be something we look at.
In your opinion, what is the bull case for gold and like the main diversification benefits that gold, especially I guess we could see with income now, could provide to investors?
Well, you think about it, gold's been around for a very long time, and people have always used it for a store of value, for purchasing things, for trading things. And now, as you think about how portfolios have grown over the past 100 years, 50 years, even the past 5 years, and what people have the ability to invest in. You think about 5 years ago, 3 years ago, you couldn't really have a portfolio of Bitcoin ETFs unless you had a wallet stored somewhere. So very different access to what you can invest in. And I think when you think about a store of value, a lot of people immediately come back to gold and their investment in gold. But it's always been, a place where you could hold it, and then if you wanted to take profits, you'd sell it. You weren't earning a dividend on it. It was just sitting there in your portfolio. And if you're someone that had a static 2, 3, 4, 5% allocation to gold, it was just part of your asset allocation. Now, with the introduction of IAUI, you can still participate in the movement of gold, have some income off of the volatility around it from the options market. So it's a product that I think caught on quickly with a lot of people that we've talked to, and a lot of people that we look at that invest in some of our products because of that advantage that they see in it.
In terms of like circling back to the yield, 10 to 12% is that target yield range. What are your thoughts on that yield range? Because we're in an environment where so many investors want the highest yield possible, and I know NEOS goes for kind of like those. We could say more conservative yields that would provide investors like the best of growth and income. So, what are your thoughts on the current yield of 10 to 12%? Is it just right? Do you think it's too low? It could go higher. Maybe it's too high. I want to know your thoughts.
I think for us, as I was saying earlier, it really comes down to making sure that whenever possible, the total return can support the distributions. Sure, could we distribute more and have a bigger number? Yes, probably, but that's not going to, in our opinion, help the growth of the fund over time. And we want the fund to grow. We want the goal is at the end of the year, a client looks at their IAUI or any of the products that we have out there, and if the underlying market for it, say gold in this example, has moved higher, we hope that IAUI has moved higher with it, and at the same time paid out some nice distribution. So if you could have that price return and that nice distribution, that is important to us. It's important to all of us. I personally own all 13 of our ETFs, and I want to make sure my portfolio grows over time outside of the distributions I receive off of it. So I know it's important for me and the other portfolio manager, Garrett here, and the entire team to make sure that as we build these products, that they could participate with the underlying, reference asset, whether it's gold, Bitcoin, S&P 500, NASDAQ 100, Russell 2000. We want to be able to participate with that.
We got monthly income, and new products are launching where they're all weekly, or investors, or should I say ETF issuers, are going from monthly to weekly. So I'm going to ask you one more, again, why not weekly income? But investors do like that you guys are sticking with monthly income and not switching it over to weekly.
Yeah, so we like the monthly distribution calendar. We like those 12 payouts a year. It makes sense for our products. It makes sense for how we manage the products. So to think about moving to weekly is not on the table right now. With having more products now, we have 13 ETFs, and we're, like I said earlier, we have 6 in registration that we can hopefully get out before year end. And with more ETFs, we might change up the calendar next year in a sense. Where they still be paying monthly, but you might have certain suites paying on certain weeks, not going to a weekly payout for each ETF, where we want to stay with the monthly for now.
Who is the ideal investor for IAUI? Is it an income-focused investor, inflation hedgers, maybe somebody who is like a general ETF investor, or like something I'm missing?
No, I think all of the above. I think if, again, it comes down to the individual investor, but we've seen these put in people's portfolio. They just want the income, and it's another asset class that they could be involved in to get that income. We've seen some that look at it as a store value and inflation hedge, and then they realize that if they're getting income off this and suddenly gold goes sideways or moves lower over a period of time, that they might outperform gold by the amount of premium that's coming in on a monthly basis. So there's always that part of it too, to have a lower vol gold exposure for them. So we see it in all different types of accounts from people that invest. and all different types of holders. So I think it's a product that if you're in the income space, it's something you should probably just take a look at and understand more about. Or if you're in the space where you actually hold some physical gold or a gold ETF, that it might be something of interest to you as well.
Does IAUI have the tax efficiency like SPYI and QQQI, for example?
So it does actually get the 1256. So while it doesn't trade index options, it trades GLD flex options. We did get the opinion that it is treated as a 1256 contract. And there's some rules around what a 1256 is. Not all index options are 1256, for example, but there is the ability for a commodity linked ETP flex option to be considered a 1256. And we have that opinion for this. And that's how they'll be classified, where you get that 60% long-term cap gains, 40% short-term, which at the end of the year, hopefully makes it a more tax-efficient net after-tax distribution versus the gross of just about 12% currently that's going out. So we don't know those exact numbers until the end of the year hits, and the auditors and the tax team at our fund accounting and fund tax team go through everything to say, hey, this is what the 1099s are going to look like. But we did want to try to construct this product as tax efficiently as we could. And the GLD flex options are getting that 1256 treatment.
Now, how important is it for investors, or at least in this product, to have that Section 1256 treatment versus not having it? So do you think it's like a big deal for investors to have that tax efficiency of Section 1256, 60% long-term, 40% short-term, versus just not having it at all?
In our opinion, yes, it's important, because you think about these option portfolios, we're rolling on a monthly basis for the short calls. We're rolling on a quarterly basis for the synthetic long. So that's all short-term trading. It's all less than a year. And if you think about all that short-term trading, any P&L coming off of that without the 1256 would be considered, or might be considered, just short-term capital gains or ordinary income. So for us, we want to make sure it can be a little bit more tax efficient, bring in the 1256 contracts where you're getting that split 60-40, no matter the holding period, is very important for us here at NEOS.
We've talked about great things about IAUI and gold and whatnot, but what are some of the main risks that you see for a gold product?
Risk for investing in any part of the market is up to the person who's taking that risk, whether they want to take equity risk, commodity risk, fixed income risk. I think it comes down to the individual person. Listen, gold's seen a huge run this year, and we've seen a little bit of a pullback the past few days. Does that continue, or does it turn around and move higher? I wish I knew. But I think there's always the risk of having, when any reference asset moves or is volatile, as we've seen gold be in the past year, there's always risk that it pulls back, and maybe you enter at the wrong point, or maybe you didn't time it right. And this is one of the things we always talk to people, a lot of people bring up around our Bitcoin product, because a lot of people look at Bitcoin and they didn't look at it until they heard about it and didn't want to think about it for years. And then it was at 25,000. They're like, I missed it. And then it was at 50 and they hated it. And then it was at 100,000. And they're like, why don't I own any Bitcoin? And so then they're thinking, like, when do I invest in Bitcoin? Do I wait till it pulls back to 75,000, or do I just buy it now because it's going to go to 200,000, or whatever the case may be? Same type of concept for gold. And the way we look at it as, you can get into a product like IAUI or BTCI, and yes, you have the underlying risk of those products moving lower or moving up and down and being volatile, but you can earn some income off of them while they are, potentially maybe going sideways, maybe moving higher, possibly moving lower. If they're moving sideways to lower, you should outperform them a little by the amount of premium coming in. If they're moving higher, you should be able to participate, maybe not in all the upside, but you're still getting some income at the same time. So you don't have to think about so much about exactly picking your spot in gold, where it is per ounce that day, or where Bitcoin is. Is it at 100,000 or 112,000? Where do I buy it? So we look at it as just, our products are just giving investors different solutions that can help them along their journey. And, for us, as you know, NEO stands for Next Evolution Option Strategies. We're always trying to think of ways that an option portfolio can help lower volatility, potentially hedge some of the portfolios that we have out there with the hedge products, or enhance the income of fixed income products, or give you income in products that you normally don't get income from, gold, Bitcoin, and so forth.
The expense ratio of IAUI is 0.78%. So walk me through how that expense ratio was determined compared to your other ETF product lineup.
No, it's a good question. I think when we think about our product lineup, all these portfolios are active in nature. So active products usually are more in the, call it 65 to 99 basis point range. And for us, we wanted all our equity products to be competitive within that range. Of course, there are the larger firms that could cut costs in half, and we're not looking to go to on a fee war with anybody of that kind of size because they'd always win. But you think about where we priced, say, our equity high income at 68 basis points, and then our Bitcoin as high as 98 basis points. For the gold products, 78 felt right because there is a little bit more trading work, trading knowledge that goes into managing the synthetic long and the underlying ETP, as well as the short calls. So we wanted to price it a little higher than where our equity high income products are, but we wanted to keep it a little lower than Bitcoin. So 78 felt right for us.
In your opinion, how do you think gold should perform in a market downturn? Because we're seeing the market go to all-time highs and continue to run up to all-time highs. And investors have SPYI, QQQI as like their main holding, I'm assuming, from NEOS. And then we have gold, which is kind of like that safe haven, that hedge. So how do you think a market downturn could affect gold or even just affect IAUI's overall performance?
Sure. Listen, in the market downturn, yes, sometimes people go and move to gold for that store of value, that safety net, if you will. But as we've seen, sometimes these asset classes move hand in hand. Yes, we're at all-time highs in the equity markets, and if the equity markets start pulling back, very well could see gold pull back with it. Maybe not, though. We could also see where everybody thought it was something of a different type of value in Bitcoin. And now we see that Bitcoin really trades along the same lines as tech does and kind of follows where the NASDAQ 100 is. Yes, are there safe havens in the market? Maybe perceived safe havens, but we've seen how volatile and quick this market can turn around. And for us, we want to make sure that if the market's coming in, and yes, maybe you're doing a little better in a SPYI versus the S&P 500 just because of that added income. But we want to make sure when the market turns around and starts moving higher again, that we're there to participate with it. So if we do have a prolonged or even quick downturn in gold for whatever reason, we want to make sure that when it does turn back around, that we can participate with that upside move as well.
What do you think is one thing that investors are getting wrong about IAUI or just NEOS as an ETF company?
I think for us, the biggest thing is education. One of the things we talk about is not all option strategies are created equally. So Garrett and I have been doing this for a very long time. The team here has been doing it for a long time. While NEOS is 3 years old, we've been in the ETF space for well over a decade, managing option-based products, bringing out the earliest option-based products, and managing products like this on the private side for large family offices, for pensions, endowments prior to NEOS. So when we think about us, we only focus on this space. And I think a lot of people, because of the growth of the option derivative space within the ETF market, I think I looked last month and there's over 700 ETFs now that use some kind of option driven. That includes the defined outcome and includes the buffered products. But if you think about how fast that has grown over the past couple of years, there's a lot of things when people are thinking about, oh, I want an option-based product. Maybe it's for income. Maybe it's to hedge your downside. Maybe it's to give you a defined outcome. Whatever you're looking for, there's so many funds out there to look. And we always kind of preach like, educate yourselves, whether it's reading, diving into the actual portfolios. The nice thing about ETFs is they're transparent. So you can go on our website at any time, pull up the holdings of one of our ETFs, and that's what's in the basket that day. And you can say, okay, now I understand it. Now I understand what they're doing in this portfolio. And you could track it on your own if you want and give you a better understanding. Whether it's our ETF or somebody else's, I think it's all about education, coming to channels like this and learning as much as you can. And then really thinking about, as an investor, what are your needs? Do you have income needs from your portfolio? Are you looking for more growth because you're younger and you have a longer time horizon and you don't need the income yet? Whatever it may be, then you can start to build your portfolio. And I think for us at NEOS, it's really important to be part of that education process. We have a number of tools on our website, videos, some things that people are always asking us, whether it's about return of capital, index options. We have a podcast on our website that we put out on a monthly basis to talk about just the market in general and some of our products, and so people can learn a little more. So it's really important for that education piece, because sometimes someone might just look and say, talk about what you talked about earlier, saying, oh, NEOS has a 12% distribution on IAUI, but this other product has a 20%. Is it better? I think you got to do your homework to figure out, is that distribution more tax efficient? Is the distribution higher for a reason? Is there a possibility of eroding the NAV in the higher one? So it's all the questions you have to ask yourself as you're doing your homework.
How does the NEOS team manage the options chains within the ETFs? Because I know you guys do all your options in-house and not like outsource it. So what does like a day-to-day look like for the NEOS team to manage all your ETF products, maybe specifically IAUI?
The busiest day is usually the end of the month when we're rolling all these portfolios. So when you think about that, we have a very experienced trading team, 3 traders on the desk, all with 20 plus years trading experience, very deep knowledge of the options market, and of other products within the market. So it's always nice to sit there, work with them, because they know what they're doing. And if you think about that month-end roll, we're rolling all the short calls for all of our high-income products. So whether it's SPYI, QQQI, IWMI, then the hedge products as well, SPYH and QQQH, and then of course all the alts, Bitcoin, gold, real estate. So it gets to be busy, and how the process kind of works is we run all of our models looking at each individual ETF, and as we get towards the end of the day, those models are saying, hey, we should be closing out the previous short calls and rolling into these short calls that are about 7 weeks out. Once we have all the actual positions that we're going to trade, then it also sizes up the notional after that to say we should be overlaying on, for example, 70% of the portfolio, or this month it's going to be 73% of the portfolio, or something like that. And then once we have all of that, that's when the traders go to work and start rolling the portfolios. When I say rolling, they're buying back the short calls that we currently have and putting on the new short calls at the same time. So the portfolio is never without an option position in it. So that process is important to us. It takes time. And we have a very experienced team here that does that. And we do everything in-house here, from development of these products, research, to finally getting to a point where we put it in registration with our fund counsel, and then getting to the process where we launch it with our trading team here. We have a great lead market maker. We have other market makers that are always involved in the names. And so for us, we've built a nice community on the trading side to help us execute these products through our prime broker or lead market maker or one of the other brokers that we use. And then our trading team manages that process and has those relationships.
The September distribution to investors from IAUI, 90% of such dividend will be return of capital. So can you explain what is return of capital, why the monthly dividends are mostly categorized as return of capital?
That's a good question. So technically, that number is coming from a 19A1 notice, which is required to go out. And that looks at it as what could be the possible highest percentage of return of capital from fund accounting, doing a quick review of the income coming in, the trading that happened, and so forth. And they put those numbers out that we then have to put on the website on a monthly basis after the distributions. But that's not exactly what the number will be at the end of the year when 1099s come out. We don't know that until fund accounting actually goes through, and then those numbers are audited and they go through each trade and look at what happened throughout the previous year. So it very well could be 90% at the end of the year, but it very well could be much lower. We don't know until the end of the year. And for them to do that on a monthly basis would be a pretty big task, which they don't do. Those 19A notices are not always fully accurate. But to give you an idea of what return of capital is, if you think about some of these portfolios, and I'll just use SPYI as an example, because SPYI had a full calendar year last year where you could think about how it performed. SPYI last year was up just over 19% total return. And there, if you think about the S&P 500 last year, it was up 25%. So it captured a good portion of the upside of the S&P 500. Out of that 19% total return, the fund distributed about 12%, just below 12% for 2024. And out of that, call it 12% distribution, just about 93% of that last year was considered a return of capital. So you say, how can you have a return of capital if you have upside appreciation? The total return of the fund is up on the year and you distributed less than the total return. And the idea about it, what we like about the return of capital structure, because from an IRS standpoint, what return of capital does is it lowers your cost basis and defers your taxes down the road. And if you defer your taxes down the road to a point for maybe you sell the ETF and you've held it over a year, you're going to pay a long-term cap gain versus an ordinary income in the year you receive the income. Or you potentially hold the ETF for a very long time and you exhaust your cost basis to zero, and those distributions are then being paid. You're paying long-term cap gains on those distributions. So if you think about the actual tax efficiency behind that, you're converting what would be an ordinary income in the year you received it to potentially a long-term cap gain down the road. So very different from a tax classification standpoint. How does that happen within the portfolio? You think about SPYI's example, you have this underlying equity portfolio that's not really touched. We're tracking the S&P 500 in full replication. And then, of course, the S&P has its additions, deletions, and those trades happen throughout the year when the S&P does it, and we follow that. But overall, the underlying portfolio is not touched. So in a year where you have 25% appreciation, and the previous year it was up 26%, you have this built up book of unrealized gains within the portfolio. But the option portfolio is rolling on a monthly basis. And in a very bull market, over time, you will have probably more losses in the short call portfolio and those are realized. And the nice part about those losses is they can be carried forward indefinitely in the ETF structure. So when you have these built up losses and you're distributing out the cash that's coming in from the short calls, that can be deemed a return of capital. And that's why in 2024, you saw that in SPYI. So it's really just looking at how return of capital is classified from an IRS standpoint. We're not trying to return principal. As you could see, if the fund last year was up 19% and we only distributed out 12%, we're not returning principal, but from an actual tax standpoint, it could be classified as a return of capital, which just defers your taxes down the road and, of course, lowers your cost basis.
What are some ETFs that NEOS has that could potentially add diversification to SPYI and QQQI?
We have our high income SPYI, QQQI, which you just mentioned, which is the S&P 500 and NASDAQ 100. We also have our IWMI, which is our Russell 2000. And if you think about the environment we're going into right now where rates are being cut, this is usually historically a time when small caps do really well, because you think about most small cap companies are building their companies and financing their companies from borrowing money. And if rates come in, it works out better for those small caps. And so we think about, in an environment where rates are getting cut, we saw one cut, we have potentially two more this year, and see what happens going into 26. And in that environment, I think something like IWMI, our Russell 2000 product, might, be something to look at. We talked about it earlier, being at all-time highs. Are people nervous about being at all-time highs? Again, do they want to stay invested in the NASDAQ or the S&P, but want to take some risk off the table? Maybe looking at one of our hedged products, QQQH or SPYH, might be a place to look to say you can still participate in the upside, but these will give you a measure of downside protection. They're not going to hedge you to zero, but they'll give you a measure of downside protection in a lower vol product, and you'll have a little bit lower of a distribution because we're spending some of that on a long put spread. Then when you think about, yes, if you're looking to kind of downshift, do you look at some of our fixed income products, whether it's our high yield bond product, HYBI, our core aggregate bond product, BNDI, or even some of our treasury products, TLTI, which is our 20-year plus, or CSHI, which is our 1 to 3 month T-bill. Those are some places that a lot of people look and say, that's a little bit more conservative. That's where I'd like to be. All of our fixed income, you'll notice the name is enhanced. We're trying to enhance the income over whatever the underlying is doing. And then, of course, you have the other side of it, where if you want to take some more risks, there's, of course, BTCI with Bitcoin, IAUI, which we're talking about today with gold, in our alternative space, and then our real estate IYRI. So I think when you think about our lineup and the funds we are hopefully going to get out this year, you think about what the lineup looks like. There's a lot of ways you could potentially diversify your portfolio and build an asset allocation with income with the NEOS products.
Talk to me about some of the new ETFs you guys have in store for investors.
So right now we are, of course, on a holding pattern while the government shut down. And hopefully they could sort that out and everybody can get back to work soon. But while that's happening, we can't, while our ETFs might go effective, we can't bring them out at this time. But the next one to go would hopefully be our Ethereum high income. So thinking the same as our Bitcoin, but we built an Ethereum high income ETF that we're excited to get out. Then we have also our MLP and energy infrastructure. We've talked to a lot of people that have been thinking about that space and how can you earn income and be invested in kind of this energy infrastructure underlying portfolio. We have an equity long short, which we're excited to bring out towards the end of the year if we can get it out. This would be an actual equity long short where it's long, 30 plus equity names and short 30 plus equity names with an option overlay to add to that income. The long portfolio is more of a longer term, usually holding, whereas the short portfolio is more traded on a weekly or so basis. So we're excited about that. But we also, which is really excited about, is our boosted series. So we filed for 3 boosted ETFs, and those ETFs are based on SPYI, QQQI, and BTCI, where they're levered versions of those 3 ETFs. And the leverage we're looking at is 1.5 times. And looking to, when you think about a covered call product, you're giving away some of the upside, especially in these bull markets. We'd like to get it back to where you're capturing some more of that upside and giving a little bit of leverage, 1.5 times to a BTCI, to QQQI, to SPYI. And we're doing that through option portfolios. A little different. A lot of people look at swaps and do a daily swap to keep you in line. And those are more tradable products sometimes. So for us, we're looking, again, more long-term 1.5 leverage for each of those products. So we're excited and hopefully get that out, towards the end of the year. If everybody can, government can reopen and everybody can get back to work.
I'm assuming that the boosted series will be the most hyped one. Now, why do you think that could be?
I think, when you think about our offerings in the boosted series, we'll talk about the S&P and the NASDAQ. Think about the NASDAQ. If we have the boosted QQQI, you're taking more equity risk to get more income and more upside. Then we have our core QQQI, which everybody knows. And then we have our hedge or a downshift down to QQQH. So it's really thinking about just across the NASDAQ 100, what kind of risk level and what kind of income are you looking for? And if you want to take more risk, go with the boosted. If you want to just stick with QQQI, great. If you're looking at potentially pulling back, want the equity exposure, but don't want as much risk, and maybe want a lower vol product, QQQH might fit for you. So we're really excited about it because I think it's something a little different. It's something, a little innovative from our perspective, and it's kind of fits in with our, pushing the market in different directions with what kind of funds we're bringing out.
In terms of the long short ETF, what's the thought process behind launching that type of fund versus all the other ones that you guys currently have, and just why that long short ETF filing for it?
Sure. No, I think for that product, it's a quantitative based long short hedge fund model, which fits into everything we do here. We're all about data, whether it's building portfolios or it's working with our marketing team or our sales team. We're all about using the data to have more efficiencies. And I think as we built with the team this long short portfolio and then have this option overlay, it just made a lot of sense to give you kind of more of that put you in more of that alts bucket, to have a long short, really long short ETF with that option overlay. No one that I know of is really doing that. There might be 1 or 2 out there, but we're excited to get this one out.
For newer investors to cover calls, How should they be doing their own research, and even some mistakes to avoid when investing in a cover call ETF, high ETF income products?
Yes, I think the research is the key part. You said it right there. I think do your homework, spend time looking at these different ETFs. Don't just look at the distribution because the distribution can change month over month. Look at the total return. The total return includes the distribution, and that's really important to understand what the total return of the product is over time versus others in the peer category that you're looking at. So look at that as you're doing your comparisons. And then next, try to educate yourself around what is a little bit more tax efficient. What does it mean to have an index option in a portfolio versus, say, an equity linked note, and understand how that works and what that means at the end of the year when you get your 1099, because you're the one that's going to have to pay the taxes on whatever distributions you received. So it's important to understand that part as well.
Thank you so much, Mr. Troy Cates, the co-founder and managing partner of NEOS Investments. Now, you guys could look at the NEOS website for any more additional information on IAUI and any ETF that we've talked about in this video. Now, if you guys like this video, please give it a like because this cute puppy did. Thank you so much for watching. And once again, this is not financial advice. Do your own research. Investing is risky once again. And check out our last video on your screen. I love you guys so much. Crush on the stock market and take it easy. Peace.